Welcome to today's video. First, we'll unpack how co-signing a loan can directly impact your ability to buy a home. Then, we'll connect these concepts to debt-to-income, or DTI, rules, and what lenders actually do with co-signed debts. Next, we'll explain when and how you can exclude a co-signed payment under common guidelines, what first-time homebuyer status really means for couples, and why even a single late payment on the co-signed loan can jeopardize your own mortgage approval. Finally, we'll give you a practical action plan, a checklist, and a case study, followed by a quick quiz to reinforce your understanding. Let's get started. Here's our roadmap. First, we'll clarify what co-signing truly means from a lender's perspective. Next, we will walk through DTI mechanics and when co-signed debt may be excluded. Then, we cover first-time homebuyer eligibility nuances for couples. After that, we'll outline the credit risks if the primary borrowers miss payments. We'll then give immediate protective actions, a documentation checklist, and a case study. Lastly, we'll reinforce learning with quick quizzes and summarize key takeaways. Before we dive in, a quick but important disclaimer. This content is educational and general in nature. It is not legal, tax, or financial advice. Lending programs and underwriting rules change frequently and can vary by lender, state, and loan type. Please consult a licensed mortgage professional who can review your documents and goals to give you specific advice. Now, to set the foundation, co-signing is legally binding. Even if you never see or use the property or the loan proceeds, lenders treat the co-signed obligation as if it were yours. This means the payment typically counts fully in your DTI, reducing the mortgage you can qualify for. Even worse, if the primary borrower pays late, the late mark hits your credit too. So co-signing impacts both qualification and credit risk. Let's connect this to DTI. Debt to income measures monthly debt payments divided by your gross monthly income. By default, lenders include co-signed payments in your DTI. However, under common agency guidelines, you may exclude a co-signed loan as a contingent liability if you provide strong evidence. Specifically, you need at least 12 months of on-time payments made by the primary borrowers, drawn directly from their own bank accounts, substantiated by bank statements or canceled checks. If you cannot produce this proof, expect the lender to include the entire co-signed payment in your DTI, which can push you over program limits and reduce your borrowing capacity. This diagram illustrates how a typical DTI might be distributed across debts. Notice how a co-signed mortgage can consume a large portion of your allowable DTI room. If that co-signed payment cannot be excluded, it crowds out capacity for your new mortgage. If it can be excluded with proper documentation, your DTI may drop substantially, potentially restoring eligibility. Next, let's address first-time homebuyer status. A frequent misconception is that if one spouse has previously owned a home or co-signed a mortgage, the other spouse automatically loses first-time homebuyer eligibility. That's generally not correct. If you personally have never held ownership interest in a primary residence, you can still be considered a first-time buyer. However, if you must use your spouse's income to qualify, many programs will evaluate both borrowers, which can restrict access to those programs. A practical strategy is to see whether the eligible partner alone can qualify, preserving access to first-time buyer benefits such as grants or reduced down payment programs. Building on the FTB section, here's a trade-off analysis. Joint applications let you combine incomes, which can increase your purchase power, but they also bring in any co-signed debts and may jeopardize FTB program eligibility if one spouse is not eligible. Solo applications, on the other hand, may preserve FTB benefits and bypass the ineligible spouse's credit issues, but they restrict maximum loan size to what the eligible partner alone can support. Evaluate both paths with your broker to determine which strategy aligns with your goals and constraints. Now let's discuss the credit hazard. If the primary borrowers miss a payment, that delinquency appears on your credit just like it was your loan, because legally, it is. Even a single 30-day late on a mortgage can lead to an automatic denial under many programs. Therefore, proactively monitoring payment history is not optional. It's essential. Verify payments every month, and have contingency plans ready in case the primary borrowers fall behind. Moving into solutions. Start by demanding documentation. Set a recurring reminder before the payment due date to request evidence that the payment cleared from the primary borrower's account. Next, pursue release by having the primary borrowers refinance to remove you from the loan. This is the cleanest fix. Meanwhile, consult an experienced mortgage broker who can tell you exactly what documentation will allow exclusion of the co-signed debt. Also, perform a conservative affordability test to see if you could cover both the new mortgage and the co-signed payment if the primary borrowers stopped paying. If not, your household is overextended, and alternatives such as selling the property or downsizing should be explored. Here is the decision path. First, determine if the primary borrowers can refinance now and remove you. If yes, that's usually best. If not, ask whether you can document at least 12 months of on-time payments from the primary borrower's own accounts. If you can, you may be able to exclude the payment for your own mortgage qualification. If you cannot, evaluate whether you can afford both payments should the primary borrowers stop paying. If you cannot, the prudent move is to consider selling or downsizing to reduce risk before applying for your mortgage. This table summarizes the documentation lenders typically seek to exclude co-signed debt. You need at least 12 consecutive months of on-time payments verified by bank statements or canceled checks from the primary borrower's own account. Payments should not be routed from your accounts. If any payment was 30 days late, the 12-month window resets. Some lenders may also request a brief letter of explanation that describes the payment arrangement and clarifies your non-responsibility for making payments. Let's run the numbers. DTI equals total monthly debt payments divided by gross monthly income. Suppose your income is $9,000 per month. Your recurring debts, excluding the co-signed mortgage, total $750. Your proposed new mortgage payment, principal, interest, taxes, and insurance is estimated at $2,700. The co-signed mortgage payment is $2,100. If the co-signed mortgage is included, your DTI becomes $750 plus $2,700 plus $2,100, divided by 9,000, which is approximately 61.7%. Likely a denial for most programs. If the co-signed mortgage is properly excluded with documentation, your DTI becomes $750 plus $2,700, divided by 9,000, or about 38.3%, which is potentially within many program limits. This is why documentation matters. Quiz time. Question: to exclude a co-signed mortgage payment from your DTI under major guidelines, what is typically required? Option A: a personal statement promising you will not pay the loan. Option B: 12 or more months of on-time payments made from the primary borrower's own account, proven by statements or canceled checks. Option C: a letter from a friend confirming the borrower is reliable. Option D: proof that the property was never your primary residence. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Lenders generally require at least 12 months of on-time payments made from the primary borrower's own account, verified via bank statements, or canceled checks. This evidence supports treating the loan as a contingent liability, allowing exclusion from your DTI. Second quiz. Question: if your spouse previously co-signed a mortgage but you have never owned a primary residence, are you still potentially eligible for first-time homebuyer programs? Option A: no. Co-signing disqualifies the entire couple. Option B: yes, you may still be eligible if you qualify on your own and meet program rules. Option C: only if your spouse is removed from that mortgage. Option D: only after 7 years have passed. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. If you have never owned a primary residence, you may still qualify as a first-time homebuyer, particularly if you apply on your own. Many programs, however, evaluate the entire borrowing unit when both spouses are on the loan, which can affect eligibility. To summarize the major points. First, co-signed debt typically counts in your DTI unless you can exclude it as a contingent liability. Second, exclusion requires at least 12 months of on-time payments, documented from the primary borrower's own account. Third, first-time homebuyer status may still apply to the spouse who has never owned, especially if qualifying solo. Fourth, even a single 30-day mortgage late can severely hurt approval odds, so monitor payments proactively. Finally, pursue a clean release, exclusion, or restructuring plan to protect your borrowing power. As we wrap up, here are practical next steps. Review your exposure and calculate your DTI today. Start gathering 12 months of payment documentation from the primary borrowers. Schedule a consultation with an experienced mortgage broker to map out whether you should apply jointly or solo, based on your DTI and first-time homebuyer goals. Taking these steps now can preserve your eligibility and strengthen your approval odds. Thanks for watching. If this video helped, please like, share, and subscribe to support the channel and help others discover this information. Post your questions and real-world experiences in the comments. Your story could help someone else avoid a costly mistake. See you in the next video.